Hello and welcome to this special webinar on Diwali picks from HDFC Securities. First of all, season's greetings to all of you. May this Diwali bring you all a lot of happiness and wealth. Diwali is an auspicious time according to Hindu calendar. It symbolizes the victory of light over darkness, knowledge over ignorance, and good over evil. Like any religious festival, there are a plethora of beliefs, customs, and traditions associated with Diwali. One such tradition is Murat trading. Murat trading is a 1 hour window or trading session. This time around, it's going to be on this coming Sunday between 6:15 to 7:15 that occurs on the day of Diwali. It is considered an auspicious time to invest in stocks. According to beliefs, people trading during this 1 hour have a better chance of earning wealth and gaining prosperity throughout the year. Now, Indian equity markets have delivered a stellar performance over the last Samvat year, generating substantial wealth for investors. Though the Nifty was up just 10.8%, broader markets performed very well. The Nifty Mid Cap Index rose 31% and the Nifty Small Cap Index rose even better by 38%. Among the sectors, PSU Bank and Realty did very well. This performance was mainly achieved despite a lot of headwinds, which include rate hikes, energy crisis, the conflict in Russia, Ukraine area, and then the latest conflict between Israel and Hamas, heightened inflation, etc., etc. Now, the listed universe has been performing better all this while as compared to the unlisted or the unorganized sector. Basically, a lot of businesses are shifting from unorganized sector to the organized sector. The organized sector has now achieved some sort of they have become more adept at cost management, and they enjoy a lot of moats. Now, Indian markets did well in most months, mainly aided by FPI flows and local flows, which have now become very dominant. Except in the early part of the year, where the FPI's flows were negative, mainly due to the COVID resurgence fears in China, the subdued December quarter earnings, and the Adani Group revelations. However, on an overall basis, I think Indian markets were quite insulated from the global financial and geopolitical developments till about September, post which the Israel-Hamas conflict created some impact on Indian markets. The remarkable performance of the Indian economy and the equity markets in the last year has underscored the country's potential as a significant player in the global financial landscape, inviting both domestic and international capital to participate in its growth story. FPIs flocked to the Indian markets, bringing in net inflows in all months except in Jan, Feb, and September, October, and till now in November. Part of these flows got diverted from China as that market continued to underperform. A lot of global financial institutions and brokerages have upgraded the India's GDP forecast while downgrading that of a lot of other countries and regions. JP Morgan has added Indian GSEC to its government bond index emerging market suite of fixed income benchmarks commencing 28th of June 2024 with a maximum index weight of 10%. This inclusion is likely to attract between $20 to $25 billion of net foreign purchases into the Indian domestic debt market. Morgan Stanley on 20th of October upgraded India to standout overweight, citing the relative economic and earnings growth, which is on an improving trend, and the macro stability setup, which looks sufficient to withstand the higher real rate environment. Now, so we have already covered this. We have covered this. Now, these are the past Diwali picks performances by HDFC Securities. If you will see 2019, 20, 21, 22, the Diwali picks returns were between 13% to 27%, whereas the Nifty returns except in the year 2020 where there was COVID-led fall and then a sharp rise. HSL's Diwali picks performance has been exemplary. Then let us now review what happened, how the last Diwali's picks have performed. Now, barring a single recommendation, all the rest of last Samvat's picks not only met the targets but also managed to scale much higher levels. Now, we had a lot of stocks, especially RVNL as a stock did very well. RVNL, the high percentage return was 442% from the entry level. So we entered at 37 rupees and the high for the year was 199 rupees. A lot of other stocks rose between 22% to 57%, and average return on a high basis was 75%. And if you go by targets, it was 20.7%, whereas the index returns were 10.6%. So almost 100% outperformance as far as the Indian, as far as the HDFC securities Diwali picks of last year are concerned. Now, last year RVNL did well mainly because railway PSU stocks enjoyed strong support from the government, which provided funding and backing for critical railway infra projects. Bharat Electronics was another performer. Again, this was surpassing our expectations. Now, it also benefited out of strong order inflow guidance of receiving big orders from the Indian Army and non-defense orders. Company has also guided for strong margins, and Defense Acquisition Council has granted acceptance of necessity to various proposals, envisaging investments of approximately rupees 7,800 crores across armed forces. Aster DM Healthcare is the another one which did very well. At the high level, it was 56.7% higher. This is a healthcare company which has presence both in India and the Gulf, and the company has been in talks to hive off or sell off its Gulf business and or its Indian business. So this led to a lot of buzz in the stock. The performance of the stock company also kept on improving, and that is why this stock performed quite well. Now, what are the current Diwali picks? Now, most of you will have the Diwali picks report with you, which is also available on the website, and a lot of you would have received through emails. These are the 10 stocks which we have recommended in the current Diwali. Dr. Reddy's, Equitas, Gale, Godrej, Grasim, Gujarat Alkalis, IOC, Kalpataru, Reliance Industries, and United Spirits. So across diversified industries, and so we have chosen a combination of stocks which will give you capital preservation and as also give you some alpha, which is a return which is better than the market. So this has been the effort on our part. Markets overall have done quite well so far, and small and mid caps have also risen quite sharply so far. So we have had a mix of large cap, mid cap, and small cap companies in our recommendations. Now, going through individual companies, I think Dr. Reddy's is a well-known company, one of the leading pharmaceutical companies, which has presence across domestic formulations, US generics, APIs, biosimilars, and differentiated formulations. So here we basically expect 16.5% CAGR in the profits, and operating margin could remain stable on the back of niche opportunities in the US. We have some concerns in the company which has been listed in our report as well as on the slide which is in front of you. But I think the triggers may work out more than the concerns. Equitas Small Finance Bank is a small cap pick from our side. It is one of the largest small finance banks in India and offers a bouquet of products and services Mainly it is into microfinance, small business loans, home loans, and vehicle finance. We are expecting a 24% CAGR in net interest income and 31% in net profit over the next 2 years. Loan book could grow at about 27% CAGR. Return on assets, which is a crucial parameter for all the finance companies, could improve to about 2% by the end of FY25. Now here also we have some concerns. Again, those have been highlighted so that one is aware as to where can things go wrong. One of it is a concentration risk. Mainly it is into Tamil Nadu, Maharashtra, and Karnataka. CASA ratio has been declining, but that is the case for most banks across the sector because now people have started to move balances from savings and current account to fixed deposits. Microfinance is a risky business, mainly facing economic downturn risks and political risks. And rising interest rates could sort of impact the growth in loan book, and also result in MTM losses for the bank. GAIL India is our third company. Here, I think it is India's leading natural gas transmission and distribution company, which owns over 11,500 kilometers of natural gas pipelines, 2,300 kilometers of LPG pipelines, 6 LPG gas processing units, and a petrochemical facility. So this company is into basically transmitting and distributing gas. Now, gas is something which the demand for which will keep on growing. Despite the advent of electric vehicles, now we are at a very nascent stage as far as EV is concerned, but gas, I think, will continue to grow for the next 5, 7, 10 years. It is also into petrochemicals. It has stakes in a lot of city gas distribution companies. So this will indirectly benefit out of those companies doing well. Now here the concerns include volatility in oil and gas prices, regulatory changes in that sector, including adverse gas pricing mechanism, subsidy sharing. And again, the city gas distribution is also under regulatory regime. So these are the main concerns faced by GAIL. Now Godrej Industry is the next one. Now here the main trigger is the restructuring or value unlocking which we expect because of the split which is expected in the Godrej family. This company is the holding company, holding stakes in consumer business, in property business. So whenever the family split occurs, and that is expected to happen over the next 1 year or so, the shareholders of Godrej Industries can benefit, and the company itself on its own is into chemical business, which till half year of 24 has not done so well. But I think going forward, I think chemicals business has seen some sort of a bottom lately, and going forward, even the standalone business can do well. Grasim is the next one. Grasim is the flagship company of Aditya Birla Group. It is into textiles, VSF, viscose stable fibers, chemicals, caustic soda, chlorine, and it is also holding company of Ultratech and Aditya Birla Capital. Apart from that, it is also announced a foray into decorative paints business with an outlay of 10,000 crores and set up plants for paints. So this is likely to be commissioned by the end of FY24, and we could gradually see re-rating of the company because so far the company has been suffering from holding company discount. Going forward, we think because of the paint business contributing more, maybe initially the paint business may not be very profitable, but the company will definitely get higher valuation due to the branded paint business where it is expected to enter. Gujarat Alkalis is the next one. Basically, again, a second largest player in caustic chlorine industry in the country, as having 20% stake. It also has stakes in GIPCL, Gujarat Gas, and GSFC. Investment value is also quite high. It has recently commissioned a caustic soda project in JV with Nalco and completed its caustic soda expansion at the Dahej. So all this will give a kicker to the company's earnings. As I said earlier, the chemical industry has not been doing well for the last couple of quarters, but I think now we are seeing some sort of a bottom formation. And from here on, the sector as well as the company can do well. Indian Oil Corporation is the next one. Now, incidentally, this company's target in the Diwali Picks report is already achieved yesterday because the company's reported good numbers and the entire refining space has been re-rated. IOC, as everyone knows, is the largest oil and gas PSU engaged in refining, pipeline transportation, and marketing of petroleum products. 10 refineries, large network of pipelines, 60,000 retail touch points. It has a lot of investments in non-core assets. It holds stakes in Chennai Petro, Petronet LNG, Lanka, IOC, ONGC, GAIL, Oil India, and other subsidiaries. So the value of their investment itself is equal to the market cap. Going forward, we think the core earnings also can do well because of volume recovery, auto fuel price hikes, which is likely to happen only after the elections, recovery in refinery margins, recovery in petchem margins, and inventory gains. Apart from this, attractive dividends are being paid out by the company, which will give some sort of a margin of safety. Kalpataru projects is the next one. Here the company has more than 4 decades of rich experience and it is into global power transmission and distribution space, railways, oil and gas, and civil infrastructure space. So mainly this is Kalpataru project is a large contractor in these happening spaces or sectors. So revenue, EBITDA, PAT could grow at 18, 27, and 36% over the next 3 years. It quotes an attractive valuation of just 9 times FY26 EPS, which is a significant discount to its Indian peers, mainly KEC International. Next one is Reliance Industries. Reliance is India's largest private sector enterprise across oil and gas exploration, petroleum refining, petrochemicals, retail, telecom, digital services, and green hydrogen. So all its business are growing well. There are various growth drivers in each of its businesses. Company is also continuing to unlock value by giving stakes to different investors in different businesses. And the stock price has not done much over the last few months. Now we expect that mean reversion to happen and the stock price could start performing. There are concerns because it is into manifold businesses, but that is normal and I think the triggers may work out better than the concerns. United Spirits is the last of our pick. Mainly it is India's biggest alcoholic beverage company manufacturing IMFL across all price points. It also imports and distributes Diageo, which is the parent brands, and has bottled in India, bottled in origin categories. So basically the liquor business has been doing well generally across India despite the various regulatory issues that it keeps facing in terms of taxes, distribution, marketing, interstate moves, rise in raw material and packaging costs, etc. So United Spirits has written off all the losses that it had in this book so far and now will focus on profitable growth led by double-digit top-line growth, sustained advertising and promotion investments, improving pricing and premium mix, and productivity gains. So now, what is the outlook of the market now? In the market, as we look ahead, the central banks, finance ministries as well as investors across the globe will struggle with inflation, which is proving out to be very sticky so far. But there is hope that we may have seen the peak in inflation, and because inflation may peak out, I think interest rates may also have already peaked out. But however, if this situation continues, the inflation interest rates continue to remain high, then we could have a slowdown across the globe. The new conflict in the Middle East, that is Israel-Hamas, in addition to the existing Russia-Ukraine conflict, could divert resources, attention, and curb risk appetite across the globe if this continues for long. Rising bond yields are impacting equity market valuations and corporate profitability. Indian macros in terms of GST collection, auto sales, direct tax collections, PMI manufacturing and services PMI, current account deficit, etc., remain very positive. The only few concern areas are fiscal deficit and the uneven spread of rainfall, which we saw lately, which may have an impact on food grain production, inflation, and rural incomes. Indian economy continues to stay in a very sweet spot relative to the many other economies, given the large demography, high domestic dependency, as well as the astute handling of uncertain times by politicians and bureaucracy. India has also seen a lot of deleveraging over the last 8 to 10 years at the macro and micro level, and hence its economy is well positioned for acceleration. Its external situation is also stable, with a current account deficit of 0.6% expected in FY24. Manufacturing sector, which was lagging so far, is likely to pick up momentum going forward. In FY24, India's GDP is likely to grow a little more than 6.5% projected by RBI. RBI, the governor, has recently said that the Q2 GDP numbers will positively surprise the street. We think that the inflation is likely to come under control by March 24, and then we could see a rate cut. Now that could spur a lot of growth across the country. Globally, India may remain in favor vis-a-vis China. India's business fundamentals, addressable opportunity, and management quality remain in very good shape. What it needs is shareholders who believe in it. Going forward, we expect markets to be volatile till the first half of 2024, even as the outcome of state and central elections will be watched closely, as would be the repercussions of the two geopolitical events. Historically, however, we have seen in the last 7 elections that markets have done well from 1 year prior to the elections to 1 year post the elections. This is a period where markets have generally done well. So even this time, we don't see that situation not continuing. Though the local fund flows have remained robust, we would need resumption of FPI flows once the global risk appetite revives. We continue to focus domestic-oriented businesses and favor opportunities in sectors like materials, pharma, oil and gas, banks, petrochemicals, consumption, power, and restructuring plays for the next year. I think with that, we have tried to finish whatever we want to cover. Now we have about 5-10 minutes for the questions. Let us see whether we have any questions so far. We would avoid stock-specific questions in this webinar. However, there is one question on REC. How is REC as a stock to buy now? We have come out with a stock note on REC yesterday. So that stock note is available on the website. You can go through it. We are bullish in the stock, and we have given the targets and entry prices in that. Indian oil is already above 100. I mentioned that one of the stock has already achieved the target because the report was released on 1st of November, and today is 9th. So in that 8 or 9 days, one of the stock has already achieved the target. So when the target price is met, should we sell these stocks or hold on to them? So ideally, a large portion of your holding should be sold when the target is achieved. If you want to continue to hold on to the balance, you can do that with keeping some trailing stop losses. So that even if the stock falls after going beyond the targets, you will exit at a profit. So that I think is a decent strategy to follow for capturing upside beyond the targets also. You 10 stocks can be bought for 270 days, 275 days based on E margin. Yes, you can, depending on the limits available in each stock. That is possible, provided you are given the declaration or approval for that. So, is the guidance to hold on till next Diwali or to book profits in full partial? So, if the targets are achieved, you should exit. As I said earlier, if in case you think the stock is likely to do even better, then maybe 50-60% of your stock you can exit it when the targets are achieved. The balance you can continue to hold, keeping a trailing stop loss in mind and sort of adhering to that trailing stop loss. So, for example, if our target is entry is 100, target is 120, you book 50-60% at 120. If it goes higher at say 130 and then comes down, at that point you can raise your trailing stop loss to 125. So if the price comes down to below 125, you can sell out and get that higher that differential 5 rupees. So that is one strategy that you can follow. Large cap tax saver fund, index fund, SIP to start. We have our mutual fund recommendations which are available on the website. You can go through them and take your necessary decision. Likely impact of 2024 general elections. Now, general elections will bring in some sort of nervousness ahead of them. We have the state elections ahead first and then the general elections. So, a lot of people would watch as to how the different parties perform in the state elections. And based on that, they may take a call as to how the general elections will turn out to be. However, some brokerages feel that in case the existing government does not sort of come to power, there is a possibility of a sharp fall in the indices, which to an extent is possible. But I think even after that sharp fall, once a government is in place, a recovery also will be will also be seen. So in that sense, you don't have to panic just because your particular government has not come to power. You may of course take some profits ahead of it, raise some cash based on your own risk appetite. But just because a particular party has not come to government, it doesn't mean that you should be very extremely panicky. Media stocks and sector. Media may because it is a very happening movement at this point, elections and all, media stocks will do well, especially the print media. But that is a window of about 6 months from now. So you will have to sort of time your exit also well. Four out of 10 recommendation is oil based. Isn't it too risky in the lingering scenario of war? So yeah, see, oil sector has not done well so far. So there has to be a mean reversion despite all the regulatory and the geopolitical impact. So the downside also in the oil stocks may not be very large, and there is value to be unlocked in each of the stocks which we have recommended. Mid cap, small cap, how will they behave going forward? Now, so both these themes have done very well so far. So in that sense, broadly, I think the sector will consolidate and correct a little bit from here. But individual stocks, individual stories in small and mid caps will keep doing well, because in India there are a lot of opportunities, a lot of listed stocks. Managements have realized the importance of value unlocking, or the market cap. What does the market cap bring to them? So they are sort of slowly improving on governance, and a lot of businesses shifting from unorganized to organized. So broadly, I think mid cap and small cap space will do well, but we don't suggest going to penny stocks or stocks which are expected to turn around just on that basis, because whenever these markets fall, these stocks will fall the most. So you'll have to do a little bit of due diligence, or you will have to rely on some advice which is well thought out. Okay, I think that covers all the questions except the stock specific questions. So thank you for joining in this webinar. And once again, wishing you all a very happy Diwali and a prosperous new year. Thank you.